Hello, and welcome back to Bonnie's Life, your home for deep dive financial analysis that cuts through the noise. This is the show where we equip you with the knowledge to navigate the turbulent waters of the global markets. I'm your host, Bonnie, and today we are dissecting one of the most volatile and pivotal months in recent crypto history, October 2025. It was a month that saw Bitcoin etch a new all-time high, only to be violently thrown off its peak by a confluence of macroeconomic tremors and unprecedented market liquidations. If you thought the crypto markets were a roller coaster before, October just redefined the ride. We're going to unpack it all, the fundamental drivers, the technical breakdowns, and the global events that sent shockwaves through the digital asset space. We'll explore what this means for your portfolio and, most importantly, where the opportunities and risks lie as we head into the final stretch of the year. We'll also do a practical analysis. If you had invested just $100 in Bitcoin and Ethereum at the start of the month, where would you stand today? The answer might surprise you. So grab your coffee, get comfortable, and let's get into the numbers. First, let's set the stage. October 2025 began with a sense of cautious optimism. Bitcoin was trading at approximately $118,503, and the market was buzzing with anticipation. The narrative was dominated by the potential for a dovish pivot from the Federal Reserve and the continued institutional adoption through Bitcoin ETFs. The first week did not disappoint. We saw a powerful surge, with Bitcoin climbing to a new all-time high of over $126,000. This rally was fueled by massive inflows into US spot Bitcoin ETFs, with some days seeing over $1 billion in net new investments. It felt like the market was finally ready to break free from the gravitational pull of macroeconomic uncertainty. But as we've learned time and time again, in crypto, the trend is your friend until it isn't. The turning point arrived abruptly. On October 10th, the market was rocked by the largest liquidation event of 2025. In a brutal 24-hour period, over $15 billion in leverage positions were wiped out, with some reports suggesting the figure was closer to $19 billion. This cascade of forced selling sent Bitcoin tumbling from its highs, erasing weeks of gains in a matter of hours. The primary catalyst was excessive leverage. Traders had become overly bullish, piling into long positions with high-risk derivatives. When the price momentum stalled, the house of cards came crashing down. This wasn't just a minor correction, it was a violent deleveraging event that reset market sentiment and exposed the fragile underbelly of the recent rally. Compounding the market's anxiety was a sudden announcement from the Trump administration regarding new tariffs. This unexpected geopolitical maneuver sent a wave of fear through all risk assets, and crypto was no exception. The announcement, a classic black swan event for the month, injected a fresh dose of uncertainty into a market already reeling from the deleveraging. It served as a stark reminder that crypto, for all its talk of being a separate financial system, remains deeply intertwined with and sensitive to the decisions of global policymakers. Then, as the market tried to find its footing in the latter half of the month, all eyes turned to the Federal Reserve. On October 29th, the Fed delivered its second consecutive interest rate cut of the year, lowering the federal funds rate by 25 basis points to a range of 3.75% to 4.00%. In a normal environment, a rate cut is typically seen as bullish for risk assets like cryptocurrencies, as it signals cheaper money and encourages investment. However, the market's reaction was lukewarm, even bearish. Why? The devil, as always, was in the details, specifically in Fed Chair Jerome Powell's subsequent press conference. While he acknowledged the need for the cut, he cast significant doubt on the prospect of further easing, stating that the committee was not on a preset course and would remain data-dependent. This hawkish undertone spooked investors. The market had priced in a more dovish, supportive Fed, and when it received ambiguity instead, it sold off. Bitcoin, which had climbed in anticipation of the news, quickly shed its gains, falling back below the psychologically important $110,000 level. Let's drill down into the performance of the two titans of crypto, Bitcoin and Ethereum. Bitcoin, as we noted, started the month at $118,503. After its thrilling ascent to a new all-time high, It ended October at approximately $109,940, a monthly decline of about 7.2%. Now, if you had invested $100 into Bitcoin on October 1st, your position would now be worth approximately $92.77. That's a loss of just over 7%, which, while not ideal, is a relatively modest drawdown, considering the intra-month volatility that saw prices swing by over 15% from the high to the low. This relative resilience, even in the face of a major market crash, underscores Bitcoin's growing role as a macro asset and a store of value, albeit a volatile one. Ethereum, however, tells a different story. It began October at a strong $4,343, but ended the month at around $3,834, a much steeper decline of nearly 12%. That same $100 investment in Ethereum would have shrunk to about $88.26. This underperformance is significant and points to a broader trend we observed throughout the month, a flight to quality within the crypto space. During times of uncertainty and market stress, capital tends to consolidate into Bitcoin. The altcoin market, including Ethereum, experienced a much more severe downturn. Data shows the total altcoin market cap is lagging significantly behind previous cycles, and retail interest, which historically has been a major driver for altcoins, has waned. The October 10th liquidation event hit Ethereum and other altcoins particularly hard, and they struggled to recover with the same vigor as Bitcoin. This divergence is a key theme for investors to watch. Now, let's talk about the engine room of these price movements. The derivatives market. The October 10th crash was a derivatives-led event. Open interest, which is the total value of outstanding futures contracts, had reached dangerously high levels. On CoinGlass, we saw total Bitcoin open interest at over $71 billion. When the market turned, those highly leveraged long positions were liquidated, creating a cascade of selling pressure that the spot market simply couldn't absorb. Interestingly, data shows that while exchanges like Binance saw a significant drop in open interest post-crash, the CME, which is a proxy for institutional involvement, actually saw its open interest rise. This suggests that while speculative retail traders were flushed out, some institutional players may have used the dip to build positions, a sign of sophisticated long-term conviction. The broader macroeconomic picture was no less complex. Beyond the Fed's actions, we saw concerning data coming out of China, with its manufacturing PMI contracting for the 7th straight month to a 6-month low. As the world's second-largest economy, a slowdown in China has ripple effects across the globe, dampening risk appetite for all assets, including crypto. Furthermore, the backdrop of ongoing geopolitical conflicts in the Middle East and the looming U.S. government shutdown added layers of uncertainty that kept many investors on the sidelines. It was a perfect storm of negative catalysts that kept any significant upside momentum for the majority of the month. So, what have we learned from our October projections? In our previous episodes, we emphasized the importance of monitoring leverage in the derivatives market and the outsized influence of Federal Reserve policy. October validated these points in dramatic fashion. We highlighted the risk of a leverage-driven washout, and that is precisely what transpired. We also noted that the market's reaction to the Fed would be nuanced, depending not just on the rate decision itself but on the forward guidance. Chair Powell's cautious tone proved to be the pivotal factor that turned a potentially bullish event into a bearish one. The key takeaway is that in today's market, crypto does not trade in a vacuum. It is a macro-sensitive asset class, and a successful trading strategy requires a deep understanding of both on-chain data and global economic trends. Looking ahead to November, what are the technicals telling us? For Bitcoin, the price action has carved out a clear range. The monthly low of around $106,400 now serves as a critical support level. A sustained break below this could open the door to a deeper correction, potentially towards the psychological $100,000 mark. On the upside, the resistance is formidable. The area between $115,000 and the all-time high near $126,000 is now a heavy zone of supply. It will take significant buying pressure, likely driven by a positive macro catalyst, to break through. Given the proximity of the US election, volatility is almost a guarantee. We can assign a 60% probability to Bitcoin remaining range-bound between $105,000 and $118,000 in the immediate term, with event-driven spikes in either direction. For Ethereum, the technical picture is more precarious. Its underperformance has left it in a weaker position. The key support to watch is the October low around $3,750. A failure to hold this level could see a swift move down towards the $3,500 area. Resistance lies near the $4,000 to $4,100 zone. For Ethereum to regain its footing, we would need to see a broader recovery in the altcoin market and a return of retail speculative interest, which seems unlikely in the current risk-off environment. The probability of further downside or consolidation for Ethereum is higher, perhaps around 70%, until we see a clear shift in market sentiment. What are the potential trading scenarios? For a risk-on scenario, a decisive election outcome perceived as pro-crypto, coupled with signs of cooling inflation that encourages a more dovish Fed, could ignite a new rally. In this case, a breakout above Bitcoin's all-time high is on the table. A technical trigger would be a daily close above $120,000 on high volume. Conversely, a contested election, renewed geopolitical flare-ups, or hawkish signals from the Fed would constitute a risk-off scenario. This could see Bitcoin retest its October lows. The key trigger to watch here would be a loss of the $106,400 support level. In conclusion, October 2025 was a brutal but illuminating month for the crypto markets. It was a stress test that revealed both the market's vulnerabilities and its underlying resilience. It washed out excessive leverage, punished undisciplined speculation, and reinforced the growing importance of macroeconomic factors. It reminded us that while the promise of a decentralized future is powerful, the path to getting there is paved with volatility and uncertainty. The $100 investment experiment showed that even in a down month, Bitcoin held its value better than many expected, while the broader altcoin market remains a higher risk, higher reward proposition. As we move forward, the lessons of October are clear. Manage your risk, pay attention to the macro landscape, and never underestimate the market's capacity for surprise. That's all the time we have for today on Bonnie's Life. I hope this analysis has provided you with clarity and a strategic edge. What are your thoughts on the market? Are you bullish or bearish for November? Let me know in the comments below. I read every single one. Don't forget to like this video, subscribe to the channel, and hit that notification bell so you never miss an episode. I'm Bonnie, and I'll see you next time.